Have you ever wondered how you can really compare a huge company in Japan to one in, say, Germany? I mean, sure, they might sell similar stuff, but financially, they could be speaking completely different languages. Well, that's where a universal translator for business comes into play. Today, we're diving into the rulebook that helps companies make that switch to a global financial language.
So let's just jump right into it. How do you, as an investor, as an analyst, as anyone really, accurately size up two businesses when their financial reports are built on totally different sets of rules? It's a massive problem in our global economy.
You see, for the longest time, most countries had their own way of doing things, their own set of rules, their own local generally accepted accounting principles, or GAAP, and these rules work just fine, inside their own borders. But for international business, they basically built invisible walls.
And this right here is the perfect way to describe it. It's an accounting Tower of Babel. You've got everyone reporting their numbers, but nobody's really speaking the same language. This makes it incredibly, almost impossibly, difficult for investors to make good decisions and truly get a handle on the risks they're taking.
But what if there was a way to fix this, to get everybody on the same page, with a common financial language that could just tear down those walls? Well, there is, and it's called International Financial Reporting Standards, or as pretty much everyone calls it, IFRS. This is the big solution the global business world has been moving toward for years now.
The whole idea behind IFRS is to create one single, high-quality set of accounting rules for everyone. The goal is simple, but it is so powerful. Bring clarity and, this is the key word, comparability to financial statements, no matter where a company calls home.
Okay, that all sounds great in theory, but just think about it for a second. How does a giant company, with decades of financial history under its old local rules, just switch? How do you even begin to do that for the very first time?
Well, you guessed it. There's a rule book for that, and that specific guide is exactly what we're digging into today.
This guide is called IFRS 1. Honestly, the best way to think about it is as the instruction manual for a massive financial renovation project. It lays out the precise steps a company has to take when it decides to adopt IFRS for the very first time.
Now, IFRS 1 breaks this whole complicated process down into 5 key issues you have to tackle. It covers everything from picking your start date and figuring out exactly which standard you have to use, to what you do with the financial gains or losses that just appear because of the switch. It also spells out what you have to explain to investors and, really importantly, where you might get a bit of a break from the rules, which can save a company from an impossible amount of historical data digging.
So let's get into the real nitty-gritty of how this big switch actually works in practice.
Okay, the very first thing you have to do, the starting line for this whole race, is to set what's called the date of transition. This date becomes the anchor for absolutely everything that comes next.
All right, check this out. Let's say a company wants to release its first IFRS report at the end of 20X8. It can't just start then. Why? Because investors need a full year of IFRS data to compare it to. That means the company actually has to go back in time, all the way to January 1st, 20X7. That day becomes their date of transition. It's the day they create their first ever brand new IFRS-compliant balance sheet. And creating that opening balance sheet, it's a huge deal. According to IFRS 1, you have to follow 4 big principles. You have to recognize everything that IFRS says you should, and you have to get rid of anything it says you shouldn't. You need to reshuffle items from your old system to fit into the new IFRS buckets. And finally, you have to measure everything using IFRS rules. Basically, you are completely restating your financial position as if you had always been using IFRS. So, as you can probably imagine, when you apply a totally new set of rules to your entire company's finances, well, some of the numbers are going to change. This whole process inevitably creates adjustments between the old local GAAP figures and the new IFRS ones.
Let's look at a really clear example. Under a company's old local rules, maybe a derivative contract they held wasn't even on the books. It had a carrying amount of 0. But under the new IFRS rules, specifically IFRS 9, derivatives have to be recognized at their fair market value. So on the transition date, let's say that value is $1 million. Bam! A $1 million asset just appeared out of nowhere.
So what do you do with that new $1 million gain? IFRS 1 is super specific about this. It doesn't get counted in the current year's profit. Instead, it gets recognized directly in retained earnings, which is like the company's lifetime savings account of profits. And this is really important because it prevents that one-time adjustment from making the company's performance for that year look way better than it actually was.
Now, making this switch isn't just some boring accounting exercise. No way. It has a massive ripple effect across the entire business, which brings us to the ultimate payoff.
The implications here are huge. Adopting IFRS is not just a job for the finance team. It's a fundamental operational shift that sends waves through the entire organization, from the IT department all the way up to the boardroom.
And the challenges are very, very real. Any bonus schemes tied to profit might need a total overhaul. IT systems have to be upgraded to handle all the new complex data. Loan agreements with banks, which are often based on specific financial numbers, might have to be completely renegotiated. And of course, there's the huge task of training your entire staff on a whole new way of thinking about the numbers.
Which really brings up the big question. With all this cost, all this complexity, and all this disruption, why on earth would any company do it? What's the real payoff here?
This quote just nails it. The ultimate benefit is for the people who actually use the financial statements, the investors. When more companies are speaking that same financial language, investors can finally compare them apples to apples, make smarter decisions, and lower their risk. That's the whole ballgame.
So yeah, the transition takes a ton of time, a ton of money, and a ton of effort. It is a very high price to pay just for clarity and compatibility. But in a truly global market, it's a price that more and more companies agree is well worth paying.
And that kind of leaves us with one last thing to think about. This big shift towards a common financial language is just one example of standardization. So, what other universal languages, whether we're talking about data or sustainability reporting or technology, are out there right now, fundamentally changing the way global business gets done?